Now adjust the volume control so that the sound can be heard in all parts of the room.
This is the Protect Your Assets podcast.
You get the idea?
It's on the internet.
Make him the cutest that I've ever seen.
Go on.
Give him two lips like
It's like no cheese I've ever tasted.
tell him that his love
Here's the Sandman.
over Sandman.
Fed Chair Powell and President Trump agree on at least one thing. Well, what's that, you ask? That's right, rates are going down sometimes this year. What does that mean? Well, it means you better make some moves right now if you're looking to lock in more income. This isn't Goldfinger, but you don't need diamonds forever to make more right now. Stick with me today as we have some fun and find out everything you need to know when it comes to bonds.
Bond. James Bond.
Good morning. Welcome to Protect Your Assets. I'm David Hollander, your host. For those of you just joining us for the first time, welcome. People around here, they call me the Sandman. That's because I help my listeners sleep well at night by answering their most troubled legal, tax, and financial questions each week. That's because I run a tax, legal, and financial firm and been doing it for over 30 years. So the Fed got together last week and Chairman Powell made it clear that they are looking to lower rates later this year. And this past week we had President Trump touring the Middle East and we had talks with China last weekend in Switzerland. So overall the market liked what it heard. And you add to all this President Trump talking about wanting rates lower overall. And you got to ask yourself, why? Why does he want rates lower so much? Well, maybe it benefits real estate. Who knows? But anyway, the 10-year Treasury yield this week went up a little bit for 4.4%. The bank prime rate right now is at 7.5%. And if you're looking at a 6-month CD, well, it's paying you around 4.2%. So all these different yields on the short end and on the longer end. What does this have to do with your account? Well, those are great questions. So we're going to talk this morning about how you can earn more interest on your safe money right now that's probably just sitting in cash at the bank earning nothing. Or worse yet, maybe you have some things that are going to mature in the next 4 to 5 months. And with rates probably going to be lower, what does that mean? Does that mean you could lose money? Well, you need to get prepared now, so stick with me for the entire show as I'm going to walk you through our playbook on falling interest rates and what you can do about it. Now, let's get started. Temporary trade deal with China boosts the market. We had the Dow Jones up 3.4% this week. The S&P big week up 5.3%, closing in on the 6,000 number once again. NASDAQ 7.2% positive. Year to date still negative, but getting much closer to even. And of course the international index, that is the star, 0.7% up for the week. Year to date up 12%, 12.6 to be exact. The 10-year Treasury, like I said, 444. For the week up 0.1%. Oil had a decent week up 1.3%, over $60 a barrel, holding tight, 61.81. But be aware of that deal with Iran. If that goes through, oil prices could drop. So we'll see what happens there as they would flood the market with their oil. So this year, with all the volatility, we've talked a lot about portfolio diversification. And I've talked about value stocks, reduced S&P 500 concentration, international equities, as we were just talking about, and, of course, alternatives. We've done shows on the subject, like gold, like FIAs, like different alternatives that you should be thinking about. If you missed any of those shows, go back and check our podcast where we got into it. So today I'm going to highlight two things. First, let's talk about international, and then, of course, as I mentioned, bonds. There's a lot to talk about bonds. One area that has truly stood out from the pack, again, when you look at the numbers, is the international equities. Like I said, year to date, the EFI index is up 12.6%. Big gain. So I wanted to highlight this asset class because now is one of those times where diversification is playing a key role in overall portfolio performance when you look at year-to-date gains. In fact, according to Bloomberg News, international equities outperformed domestic equities in the first quarter by, get this, the largest margin in almost 40 years. This is a quote directly from that article. The S&P 500 index has shed 5.1%. By the way, this was as April 30th this year, trailing the MSCI All County World Index, excluding the U.S., 6.5% gain. So that's where it was at that point. That's the widest gap in any quarter since 1988, end quote. So I had the opportunity to read this article, look at the table they had. They had over 50 different countries, including the U.S. there. Out of the 50, we ranked 45th in line of all these other countries around the world, like Poland, Spain, Greece, Chile, Germany. All these other countries blew our doors off. And so with that, the huge differential becomes a question of with the China trade deal that just happened, which again, remember, that is only a 90-day pause. And so if the Trump tariff barrage were to continue, the question right now the markets are trying to figure out is, will that take a bigger toll on the U.S. economy through stocks and damage growth and stoking inflation? This is the big question right now. It's a very good question. So if you haven't taken a look at overseas yet, I would encourage you to start looking at that, where there has been less tariffs, less trade war risk, less exposure to the falling U.S. dollar. There's also a chance that this could be the start of a new trend that could develop longer, because currently foreign stocks have momentum, as we've seen, and they still are cheaper. They're paying better dividend yields, and this has driven stock prices higher, and they're potentially still underinvested when you look at it from an overall allocation standpoint. So with all of those facts out there right now, now's a great time to be taking a look at your portfolio and seeing what sort of exposure you have to emerging markets or to developed international. Even country specific, there are opportunities that still exist that you may want to take a look at. And of course, the big one, which just happens as a result of Trump and Chair Powell pushing rates down, will be bonds. And so right now we're going to talk a lot about bonds and how falling interest rates mean that if you're prepared, you can take advantage of what's coming before it hits you. So coming up next, what we're going to talk about is, with rates falling, what should you be thinking about to protect, after all this is protect your assets, protect your fixed income, your safe money from drifting down in value. Find out what you need to do. You are listening to The Sandman. This is the Protect Your Assets show, and we will be right back.
Take the first step toward reaching your financial goals and get the information that can help you live a confident retirement. That first step is going to PYAevents.com and signing up for our next free event. That's PYAevents.com. Now back to Protect Your Assets with David Hollander, the Sandman.
Welcome back to Protect Your Assets. I'm David Hollander, also known as the Sandman around here, and that's because our goal is to help you protect more of your assets so you can sleep better at night and not worry about all the tax changes that are coming. I'm sure you heard about the big, beautiful bill that the House just kicked off this week. Tariffs, you name it. Recently, Chairman Powell testified in front of Congress, and President Trump has echoed that rates are going to go down. And if you add to that the fact that President Trump has moved several things forward, it's kind of likely that interest rates will be coming down at some point this year. So why is this unfolding scenario important to understand when it comes to your money? Well, consider this. You may be holding a lot of cash right now at the bank. And if you hold more than $250,000 at any bank, you should pay attention to what I'm about to say, FDIC covers your deposits up to $250,000, but beyond that, it doesn't. So remember the whole Silicon Valley Bank situation we had a while ago. But add to that interest rates. With interest rates falling, your money will earn less, and those rates will change frequently if you don't lock in your term. So what should you do about it? What are your options? How do you spread out your deposits? Well, there's some things we should go over this morning. So let's start out with this. First, the strategies that worked well for you during the last few years when the tech stocks were doing so much better than they are currently may not work in the environment that we're in right now, as we've seen certainly through April. And as things unfold and continue to unfold, it may not work so well either. Second, go on the defense right now, because interest rates at some point will start to come down. And when it comes to your safe money portfolio, you should be looking at everything that says fixed income or cash on your statement. That's where you'd want to start. Consider what they're paying you and for how long that interest rate is good for. You need to understand that. You have to really look at it and see how many days are they going to pay you that. For those of you who don't know what I'm talking about, well, now we're going to switch over to some bond basics.
Bond. James Bond.
So 007, as you know, has a license to kill. Oh, that's the wrong Bond. When it comes to the Fed lowering interest rates, well, they could kill your returns too, just as quickly as James Bond can with his Walter PPK. How? Why? Well, because most bonds, they pay fixed coupons, and these coupons adjust based on what the Fed publishes as their interest rate. When rates start to go lower or are published lower, you make less income. It's just that simple. And when rates are higher, you make more income. Sounds pretty basic, but here are some more bond basics for you. When you look at a bond, you will see a number of different terms. And now I encourage you to get out your pad of paper and write these down. This is your bond education. Coupon, as I said, is the rate. That's the rate that you will get paid each year that you own that bond. So let's give you some examples here. Say you have a bond coupon of 6%. In theory, you should be paid $6,000 on your $100,000 investment each and every year that you hold it. The next thing you want to look at to determine if that's really true is something called maturity. Maturity means when you get your $100,000 back. If you see it matures June 2nd of 2030, then that means as long as the institution or the government that issued it is around, you'll get your principal back. In this case, the $100,000. Next, you should look for the term callable. This means that they could call that bond away from you, literally take it away from you. In other words, stop paying you interest, pay you back your principal, and that's that. And so that rate should be published somewhere when you look at it. So if it says callable, make sure you find out when that call date is, and if that date frustrates your income plan, meaning again, let's say it was June 2nd of 2030. Let's assume your income went from that $6,000 down to $2,000. Question, would that frustrate your payments on your bills? And if so, what would you do about it? Next, look for price. Is the bond at a discount? What does that mean? Subpar. What does that mean? Or is it at par? Par is equal. Par means 100. Or is it a premium? Let me give you some examples. 100, that's how we talk about bonds. 100 would be the price per bond at par. So if you want to write something down, write 100 equal sign par, P-A-R. That's what that means. If the bond is selling at 99.895, when you look at the quote, then that is a discount, also known as subpar bond. So it's a different name for that bond. Okay, so assuming that, then it doesn't really matter to me whether I buy at a discount or at a premium, as long as my yield to call, or my yield to worst, that's another quote you'll see there, YTW, that means yield to worst, or yield to maturity, as long as the worst of those aligns with what I'm after, then I'm okay. Let me unpack that a little bit for you. Par, again, equals $100 per bond. If I pay more than that, so in this case, let's say I pay $101 per bond is the quote, that would be a premium. The discount that I mentioned earlier, 99.85, is the discount. All right, so first get a handle on that. Again, it doesn't matter if I get the rate I'm looking for in my portfolio, as long as I'm happy with the term on the interest payment. So that brings me to understanding what the true rate of return is on the bond as you look at this alphabet soup. The terms that are used to describe rates and bonds are yield to call, as I mentioned, YTC. So you could write yield to call equals YTC. Yield to worst, YTW. And that literally means yield to worst, or yield to maturity, which of course is the final maturity in some cases, but these can contradict each other, so let me explain that. So YTM = yield to maturity. You really want to pay attention to two things, yield to call and yield to worst, because those essentially could be your ultimate lowest return you could make on that bond if it was called. So an issuer can call the bond upon an event, so something could happen in the finance world and they call it and they pay you back your principal and then they're done and then you no longer get that payment. Or a date out there that, again, if it's a yield to call, you could pick that date and then that may align with your income plan because you have something else that would pick up, say when that bond matured or was called, in 5 years. So you don't lose the income. Again, if the coupon's 6%, the yield to call could be 8.371% if they call it, meaning you would make over 8% overall on that bond, which would be pretty good. And if the yield to worst is 6%, again, if you're planning on those 6% payments and that works with your plan, that could be just great as long as it fits your time horizon. Of course, you'd rather collect the 8.3%, but if they did call it and now you're flat, you don't have that income anymore, that might not work out so well. So again, these are things you have to think about as you get into the bond world. How else can you make money in bonds? Well, great question. When interest rates fall, typically the price of a bond rises. How much? Well, it depends on, among other things, all being equal, a bond's duration. What you do is you multiply the change in interest rates by the bond's duration, and you could have an estimate of its change in price. What do I mean? Duration means, again, the maturity date, which we just went over, the YTM or the YTC or the YTW. I believe the Fed will cut rates later this year. In fact, I think they're going to do it twice, and I believe that that will be equal to 2 25 basis points cuts, which will equal 50 basis points, or 0.5%. So when interest rates go down by, say, 0.5% this year, and the 10-year Treasury were to come down in relation to that, a 10-year maturity should go up by 5% in market value. Your longer maturity bonds, like let's say you go out and buy a 20 or 30-year bond, well, that should go up more typically as they are more sensitive to that change in the interest rate environment than your shorter maturity bonds like your 1 or 2 or 3 years. Again, all things being equal. So as interest rates keep falling, the value of your bonds should continue to rise, particularly if they have an average maturity as opposed to one fixed maturity. Let me explain that a little bit more. Consider this. Let's assume you had $100,000 in a bond portfolio made up of various different bonds. If U.S. interest rates fall, say 1% over the next year, the following could occur. Let's assume you had a 20-year zero coupon bond with 20-year duration. You could make $20,000 on your principal. If you had a long-term bond fund, this is a fund, that say had an 8-year average duration, you could make $8,000 of principal as that 1% drop occurred. And if you had a short-term bond fund, say that would be a 2-year duration, you could make $2,000 of principal. What's important about this is that you go and check your statements right now. Look at the funds that you own, and you can research what's the average maturity date for that particular fund to help you figure out some of these questions. Next, what can you do? Well, look at the symbol in front of the position on your statement. Is it a 3-letter or a 5-letter symbol? If so, then chances are you probably have a bond fund or an ETF of some sort, and your goal is to find out what is the average maturity. So write that down, average maturity on that particular symbol, because if the average is short, then you could lose what I explained earlier as rates were falling. If your bonds don't have a symbol, but rather have a CUSIP number, so it'd be a bunch of numbers, that is somewhat lengthy, then you probably own the individual bond itself, which I particularly like right now. That bond is backed by the ability of that issuer to pay you back, and as long as they're still around at maturity, you will get your par back for the bond. Remember, that's 100 versus 99 or 105, as I was explaining earlier. So you might want to think about if it's at 105, you would want to sell it maybe now and take that gain if you paid 100 for it, because that might already factored in what's going on in the interest rate environment, and you could take your profit now and do something else with it. So think about that. Retirement, I know it's full of complicated choices when it comes to looking at bonds or claiming Social Security right now. I'm sure after all you heard about the changes that are happening this year with Social Security. How do you make a choice when it comes to doing that so you live a comfortable retirement? You need to make sure that your current plan, your written plan, solves all these problems and adjusts with the times as interest rates change, as Social Security rates change. Your plan should be a living, breathing tool that helps you navigate this environment with the help of your advisor. If it's not, and it may not be, then guess what? You're exposed because you're not looking at everything and you're just guessing. So find out how much more you could be making by speaking to my team right now. We are giving away our retirement checklist right now, and you can get that to get started on something like this. Pick up the phone right now if you want to find out some things you could be doing right now. 866-776-8328. The number again, that's 866-PROTECT to get your retirement checklist right now. Think about it as a second opinion for no charge. 866-PROTECT. 866-PROTECT. Coming up next on Protect Your Assets, it's time for our popular They Say segment, where they say falling rates are all that matters when it comes to your bonds right now. Is that really true? There's so much more to come. You're listening to The Sandman on the Protect Your Assets show. We'll be right back.
Take the first step toward reaching your financial goals and get the information that can help you live a confident retirement. That first step is going to PYAEvents.com and signing up for our next free event. That's PYAEvents.com. Now back to Protect Your Assets with David Hollander, the Sandman.
Welcome back to Protect Your Assets. I am David Hollander, also known around here as the Sandman, and our goal is to help our listeners live a more productive, less stressed life when it comes to their retirement. After all, that's why I am called the Sandman, because I help my clients sleep well at night. If you missed any of today's special James Bond segment show today, we've been talking about bonds and what happens when interest rates start to lower. And as Chairman Powell and now President Trump are talking about lower interest rates, what does that mean to a big part of your retirement when it comes to income? Now it's time for one of our fan favorite parts of the show. This is our They Say segment, where we debunk common myths, half-truths, and sometimes just bad advice they say.
Who are they? What do they know that I don't? And what are they saying this week? Here's David Hollander, the Sandman's answer.
All I know is that I don't know.
All right, so here's one they say. They say that falling interest rates are all that really matters when it comes to looking at your bonds. Is that true? Well, it's true that is a big influence, but there are other things you should pay attention to as well. Well, like what, you ask? Well, certainly the items that I covered in the previous segment are important, but to be truly protected, it's a good idea to have your funds diversified not only in domestic fixed income, but as I was talking about again in the market segment at the top. That's why if you missed that, please go back and hear what I was saying about international markets. 2025 has been a lesson according to a study I read. It's been 40 years and since 1988 where international equities have outperformed U.S. equities. This is the first time it's happened this first quarter here in 2025 in over almost 40 years, 4 decades. Can you believe that? So international is a good place to look. And of course, international companies also have fixed income. So just realize that right now your international portfolio may be up while your domestic portfolio, some pieces of it aren't looking so good. Specifically, if you have some stocks that could still be down with everything that's going on right now. So let's take a look, shall we, at the specific opportunities that exist in the market right now. So I'm looking at a review as we look at the market. This is as of Friday, May 16th. So the market closed, and of course we were looking at bonds that day, and that these numbers change daily. So this is just, again, a overview of what was out there and available as of Friday. So here's how you want to look at different types of bonds. You have, first of all, CDs are not bonds. CDs are typically backed by FDIC, and those are issued by banks. Typically have a maturity date, like a 3-month, a 6-month, 9-month, 1-year, 2-year. You're probably very familiar with those. And according to the rates that I'm looking at right now, the 3-month average, these are averages, again, not specifics, very average. The 3-month average CD fixed is a 4.4%. When I look at a 1-year CD, the best one I can see out there at the moment, paying around a 4.4%. As you get out to the 10-year, there are 10-year CDs available, paying 4.5%. Okay, so remember, CDs are taxable, and of course, if you pay taxes, a CD may not be your best investment. And so how would you know that? Well, you meet with an advisor, and they'd help you figure that one out. Let's switch now to bonds, because that's what we've been talking about this morning, the bond market. Now, bonds are made up of various different types. Like I mentioned, you have domestic, you have international, and these could break down into those different respective categories, of course, as you look at it. Let's talk about U.S., shall we? You have U.S. Treasuries, you have Treasury zeros, which don't pay you coupons. They just mature at some point, and that's where you get all of your interest in one bullet, we'll call it, at the maturity date. You have government agencies. These are agencies that, like Fannie Mae or Freddie Mac, these are federal agencies that pay dividends to you and principal through that agency backing. You have corporate bonds. Corporate bonds break down as follows. These are the ones that I look at. I don't go below this. I look at AAA, AA, and A. That's as far down the ladder as I will go. I won't go below A. That's up to you, but in any event, I'd stick with that. Municipals, you've got AAA, AA, and single A, and then you also have taxable municipal bonds as well. So when I look at that entire market and I look at 3 months all the way out to 30 years, you see an interesting thing developing right now because of the environment that has been created by President Trump and also the Fed. Chair Powell has said that later this year, their goal is to keep inflation under control. They want to keep around the 2% level. And so in order to do that, they've discussed lowering rates at some point. And this just happened last week when they were testifying in front of Congress. So what does all that mean as this is developing? Well, first of all, the market reacts to what Chairman Powell and, as you've seen, President Trump does. In fact, sometimes the reactions are pretty swift and quick, and that's what the market is all about. After all, it is a market. So when you look at rates right now, I'll start with Treasuries. The 3-month route around 4.36%. When I go further out on the curve, something's interesting happening. There's an inflection. When I look at the 10-year, so imagine 3 months, then all the way out to 10-year is where it starts to go up above 4.365%. 10-year is at 4.436, so it's slightly up at the 10-year level. Think about that. So 3 months all the way out to 10-year. That's uncertainty there right in the market. 20 years at 4.99%. And the 30-year at 4.91%. So you heard me. So the 20 to the 30, you have another inflection. So if you can visually chart this, you can see that rates go up gradually from the 3-month to the 10-year. Then they go up some more to the 20-year, and then they start to go down out 30-year. That's literally the inflection of a curve. And so why would you go out farther on the curve to get less return? It doesn't make sense in that example. There are some other examples where that could make sense. Like where? Well, again, I'm looking at the current market, the AAA corporate market, the AA corporate market, and maybe the single A corporate market. 30-year could make sense. What do I mean? Take a look at the corporate AA right now. You've got 3.87 on the 3-month. That rises steadily to the 5-year, to the 10-year. 10 years around 5.7. These are taxable, by the way. The 20-year at 5.77, and then at the 30-year, you're getting 6.16%. Again, these are all averages, okay? There are individual bonds behind these, and you have to, again, look at these very closely because you're going to own that particular issuer if you were to buy that particular bond, so you want to be comfortable with that decision. Again, there's value here. You just have to know where to look at it and how you would structure that in your overall portfolio. So those are some pretty good rates. Let's talk about something else. Well, how much cash do you have sitting in a bank account right now? Do you really need all that cash sitting there? Are you going to spend it on a home improvement or a second home or a new car? And if you did make that purchase, is that the best way to spend that money? Might you do something else with it? Are you sitting in so much cash right now because you feel that's safe and you don't want to put it anywhere right now with things in the world being so uncertain? Well, if this describes you, then considering the following. Each week we take a look at interest rates, like I just did. What are being paid by the banks and by various companies across the world. This past week, we saw how if you are 60 years old, consider this is a different type of investment. You could wait 1 year from now, and then you could start receiving level income. This would be cash flow paid to you of 7% for the rest of your life as long as you're on planet Earth. Think about that. 7% for the rest of your life. Are you earning lower than that right now on your savings? Are you taking risks that maybe you don't need to be taking with those savings? Like I mentioned, when rates start to come down, that liquid money is going to lose money. It's just that simple. If you're unsure and you want to see if you can earn more and reduce your risk and at the same time maybe pay less in taxes, we'll call this number 866-PROTECT. We have really good coffee. We have Ritual Coffee. We have free parking. We have a very friendly staff who's anxious to meet you when you arrive. And best of all, remember, if you're hearing me right now, we are local. Plus, if you want to meet virtually, we can arrange that as well. So it's just that easy. It's so simple to get together with us and find out if you could be doing something a little different. Call this number 866-PROTECT. It's your money. Find out how to grow it better by talking to a member of my team right now, 866-PROTECT. Time for a quick break, but when I come back, how much can you earn on your short-term money right now? We'll find out when I come back. This one's a big special. It won't be around forever. It's all coming up next. Stick around.
Did If you missed any of Protect Your Assets with David Hollander, all you have to do is go to pyaradio.com where you can download or listen to our latest shows for free. Just go to pyaradio.com on your computer or mobile device when it's most convenient for you. That's pyaradio.com. Now back to Protect Your Assets with David Hollander, the Sandman.
We're back. I'm David Hollander, and you're listening to Protect Your Assets. And isn't that so important right now? Because we've found that the number one key to financial success in retirement is protecting your downside. And right now, with Chairman Powell talking about lowering interest rates, and of course President Trump wanting rates lower now, I don't think it's a matter of if, but when rates will come down. What does that mean? Well, right now, if you're getting ready to retire, think about this. If you had all or a good portion of your retirement account in your company's stock, maybe you work for Merck or United Health or Dow Chemical or Estee Lauder. Look at the diversity of those companies. Right now, you'd be sitting on a loss. Not realized, of course, but from a year ago, you'd be down over 40%. Think about that. If your portfolio was down 40%, would you be able to retire right now and live that lifestyle that you were so hoping for? Or maybe you were entering retirement and you had a big portion in your company stock and something happened and all of a sudden you lost 40%. This happens. This is reality. This is volatility in your retirement. And that does, don't kid yourself, dictate the quality of life you will live. So why live your life on a roller coaster unless, of course, you like that kind of thing? Big swings up and down in your portfolio can cause you to run out of money, and I've seen it, go back to work, and I'm sure that you don't want to do that. So today we've been doing our special bond show. No, not James Bond. This is bonds. And giving you everything you need to know to arm yourself with some information to look at the bond market as it exists today, with rates starting to come down at some point this year. We've been talking this morning about fixed income, safe money, and right now there is a special. One of the companies that we work with is paying a bonus right now, get this, of 21%. You heard me right, 21% paid immediately. This is issued and backed by the claims paying ability of this particular company. So if you're down right now in any of those stocks I mentioned, or maybe your stock's down and you want to realize some of that loss now, maybe it makes sense to do that. You could invest in this particular investment we're talking about, get a 21% bump immediately. Think about that. If you're earning 4% on your money over the next 5 years, well, that's 20% right there immediately. This will issue to age 80. There is a rider fee, they call it. It's a 95 basis point, less than 1% rider fee each year to have this. This is a 9-year hold on this particular one. And there also are indexes inside of there that you can allocate your principal to and get some of the upside of those particular markets if they were to return positive returns each and every year, with the NASDAQ, the S&P 500, and the Russell all having respective caps of 6.5, 6.25, and 7 respectively, as you were to look at that. So think about that. This 21% bonus, I'll call it, will not be around forever. And this is not some phantom income bonus. No, this is a cash bonus that credits right to your principal. You'll see it on your statement, and that will be immediate. There's nothing you have to do longer term to realize that outside of what I just talked about. Of course, there are more details, and you want to get all the facts and figures behind that. So if you want to know more about that one, again, which won't be around forever, call the number 866-PROTECT and request more information on that. And so as we talked about retirement today, I hope this was good information for you as you look at your fixed income account, as you look at the bond market out there. Things are changing, and they will continue to change. If anything's taught us a lesson here in 2025 year to date, it's certainly been a volatile year, and that volatility will continue. And with the pause button that was just pushed with China for 90 days on trade, what will that look like after the 90 days are up? And what's going to happen now that Congress has kicked off the start of the tax bill process, the big, beautiful bill that's coming. What will your tax rates look like in the future? What will you do to make sure that you keep more of your money working hard for you? Because after all, if you don't get in front of this, you're going to be behind it. It's just that simple. So I want to give a big thanks to the Protect Your Assets team, Kevin Renfer, Executive Producer, Network Manager, and of course all the fabulous producers today doing all that hard work, Zach and Nick, because without my team, I'm just another pretty voice on the radio. Thanks again, everybody. You've been listening to the Protect Your Assets show. I am David Hollander, the Sandman. Go out and make the rest of your life the best of your life.
Investment advisory services are offered through Liberty Wealth Management, a registered investment advisor. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. The strategies mentioned are not suitable for everyone. The information expressed does not consider your specific situation or objectives and may not be appropriate for all investors. Past performance is not indicative of future results. To better understand the risk associated with investing and how it reacts to different market conditions, listeners should always consult with their qualified investment professionals, financial advisors, legal or tax specialists, and conduct their due diligence before making any financial decisions or taking any action. The legal information provided on the air is not intended to substitute for callers hiring their lawyers to advise them about personal legal matters. Investments involve risk and, unless otherwise stated, are not guaranteed. Liberty Group LLC paid for the following program, and the host's views and opinions do not represent those of the station or its ownership. California Life Agent number 048569. Persons engaging the services of one affiliate of Liberty Group LLC companies should be aware that each company is operated separately. You're listening to the Protect Your Assets Radio Network.